Great. Thank you, everyone, for being here. I'm Jonathan Falik with JF Capital. This is my good friend Dan Lesser, who's the founder, president, and CEO of LW Hospitality. His bio is in the book, so we won't bore you with that because we have 9 minutes and 36 seconds left. I'm going to tee this up for Dan, who's going to do most of the talking, and he's going to walk us through what's going on in the New York City market from a performance perspective, a supply and demand perspective, a valuation perspective, and a transactions perspective. So Dan, what are you seeing?
Well, thank you, John. It's great to be here. Good morning, everybody. I always like to look at life with the positives and the negatives. So I'd like to just take a minute and talk about strengths, weaknesses, opportunities, and threats for not just the New York lodging industry, but the national industry as a whole. So let's start off with some of the strengths. There's lots of fear in the market. There's talk about recession right around the corner. But at the end of the day, I'm not an economist, but I don't see any empirical evidence that points to a recession being anywhere as close. Gasoline prices, everybody knows, fairly low on a relative basis, and that encourages travel, and that's great for travel into New York. Inbound foreign visitation, as well as capital coming into New York. New York's the capital of the world. Everybody wants to be here. Everybody wants to invest here. I was born and raised in this town, and I find it remarkable what's happened in the past 30 years. The dramatic turnaround. Yesterday we had the conference at the Marriott Marquis, and I recall doing a feasibility study in 1982 on that property, and that was really the heart of a combat zone back then. And look at that area today. It's quite remarkable. The United States is the world's beacon for safety and security, and again, everybody wants to visit here, but more importantly, they want to park their money here. Group demand has been quite strong. Some of the weaknesses in the market. Clearly, although we're not in recession, the U.S. economy has kind of been just bumping along, and it's been fairly underwhelming in terms of a recovery standpoint. A strong U.S. dollar has clearly put a damper on foreign visitors coming here, although they're still coming here in record numbers. The online travel agencies are clearly exerting negative pressure on the hotel space, and I think particularly in New York. The rising influence of labor unions, rising property taxes, values of hotels are going up dramatically, and assessors read that in the rags, and they automatically raise property values. And then you have a number of international brands that are coming here, some of whom I never heard of just a couple of years ago, and they're coming here into New York and other parts of America and trying to expand their brand presence. Of course, there's Airbnb. That's a whole topic unto itself. Some of the opportunities that I see for the space, the industry is actually very well positioned to react to any inflation. Again, I'm not an economy. I'm not saying inflation's around the corner, but you got to figure at some point inflation will rear its head again. And hotels, because of the daily leasing and the constant repricing of guest rooms with technology today on a nanosecond basis, it's a beautiful thing in an inflationary market and a rising market. It's a horrible thing in a deflationary market and a declining market. Some of the threats, clearly event risk. Cyber risk is another big thing for the space. I think a lot of folks are asleep at the switch on that. If you look back a couple of years, cyber terrorists and thieves were very focused on retail, big box outfits. And if you notice, as of late, we're seeing more and more releases about hotel companies getting attacked. And I think part of that has to do with the fact that the hotel companies have been a little slow at coming up with standardization of how to deal with cyber issues.
So Dan, how does New York City perform now? What do occupancies look like, rates look like?
So I'm actually referring to some slides that I had put together. If anybody wants the slides, we're going to make them available at the end. It's very interesting. There's a lot of negative sentiment out there, particularly in New York, about all the overbuilding. I think it's a little bit overblown. At the end of the day, there clearly is pain being exhibited right now. Demand is there. There's no question about that. Demand really has not let up. And if you look back over a long period of time, there's been a mismatch of demand for hotel rooms in New York and supply. During the recent past, we've had 20,000 rooms come online. We have another 20,000 rooms coming online. on a base of just a couple of years ago was 75,000 rooms. So there are a lot of rooms coming online, and it's not affecting the demand. It's actually pretty close to demand growth. It's affecting rate. There's no question about it. Rates are under tremendous negative pressure, not just from tremendous supply, but also from the OTAs.
Well, what's New York City occupancy actually like?
Consistently runs in the mid to high 80s on an annual basis. So think about that. It's expected to bottom out at 80% in the next couple of years when all the new supply is finally absorbed, at no less than 80%. So compare and contrast that to the national average over the past 20, 30 years has been about 62, 63%. So even at 80%, New York is a phenomenal market.
And what's driving the demand? What are the key drivers?
New York's one of those markets where you have, it runs on all cylinders. You have tremendous corporate demand, you have tremendous leisure and tourist demand, and it's a great meetings market. I mean, look, we're all meeting here. You know, what I find remarkable is that we have a convention center here in a world-class city, and I can't think of another city in the world, never mind world-class, that has a convention center with no headquarters hotel proximate to it. So I think it's been talked about for many, many years, but I do believe in the next 10, 15 years we will finally see a headquarters hotel on the far west side.
And how do lifestyle and branded or boutique, how do lifestyle and boutique hotels kind of compare performance-wise versus the kind of more vanilla branded boxes?
You know, it's actually interesting. I had done some research prior, and it surprised me a little bit. But statistics put out by Smith Travel Research, when you compare chain-affiliated with independent. Now, that's a little dicey on how you define that. I'll let Smith Travel do that. But it's very interesting. If you look at 2015 compared to 14, if you look at Q1 of this year compared to Q1 of last year, average rates for chain-affiliated hotels are about $37 to $45 higher than independent hotels. Average rates for chain-affiliated hotels are $37 to $45 higher. On a RevPAR base, it's about $39 to $47 higher. That surprised me a little bit at first. But then when I thought about it, you know, clearly there are a lot of expenses associated with operating as a chain hotel, so you better get more revenue. And then I think it's fair to say that within the independent space, you have some great product. And you have some product sort of in the middle, but you also have a lot of sort of not so good product in the independent space. And so that sort of drags down the averages. And frankly, all things being equal, independent versus chain, the independents are probably going to have to rely more on the OTAs. And now that Expedia controls that world, they're putting significant pressure on independent hotels to drop their rates when needed.
Let's jump ahead a little bit and talk about investment sales. What's happening in New York City in terms of the hotel sales market, and then break that down a little bit in terms of boutique or independent versus branded.
So it's interesting. There have been obviously no shortage of transactions over the past couple of years. Some research that I put together before this event. I mean, if you look in the broader spectrum, generally speaking, and don't go out and start placing prices on properties now based on what I'm about to say, but generally speaking, on a per pound basis, hotels in New York are trading at somewhere between, call it $500,000 a room to $750,000 a room, $750,000 a room. I know Mark Kaiser was up here just a minute ago talking about the blockbuster trade of the Baccarat at $2.1 million a key. That is an all-time high on a per pound basis for a hotel in the United States. That occurred last year. Obviously, we've had some very notable transactions in New York. Anbang's $2.1 billion acquisition of the Waldorf Astoria about 2 years ago now, and I'm not sure they know yet what they're going to do with it, so it's kind of an interesting situation. We've had no shortage of $1 million plus per key trades going as far back as 2011 when the Satai sold for over $1 million a key.
Who are the buyers in New York City?
Well, up until recently, you obviously had REITs very active in the space and very focused on New York. They're actually looking to get out now. Probably not the best time to be getting out, but that's a whole other discussion about why they need to get out. I mean, foreign capital, there's no question about it. I mean, look at who bought the Baccarat. There is an enormous amount of foreign capital from all parts of the world, from countries that I haven't even heard of before, that are looking to, I'm dead serious about that they're looking to invest in the United States. And it's interesting, some of these folks, they initially perceived New York as the United States.
So we're running out of time, but I'm going to go a couple of minutes over because I think Dan's background and commentary is so valuable. And we didn't talk about this before, but Dan, when you do a valuation analysis or an appraisal in New York City for a boutique hotel, well-performing boutique hotel versus kind of a well-performing Marriott hotel, what is different in your valuation analysis? What are you looking at? What are you concerned with? What are you troubled with, and what are your clients troubled with? What are the real distinguishing factors when you think about valuation and cash flow?
And we're talking about independent versus
branded, yeah.
Okay, I mean, listen, at the end of the day, the notion of branding a hotel, particularly in a city like New York, is by no means a slam dunk, irrespective of the statistics that I mentioned a minute ago, because that's just top line. You really need to look at the bottom line, the net cost of a brand. And New York is one of those markets where, in many cases, the justification is just not there. Hotels are very, very property specific. They're very sub-market specific. We talk in generalities about national averages and New York City averages. The hotel business is a neighborhood business. Always has been, always will be. So we're very focused on sub-markets and sub-markets within sub-markets. It's easy to just sort of broad brush and talk about New York and about how overbuilt it's getting. It's a little silly. If you're looking at a hotel opportunity, you need to look at that specific opportunity and how it competes within its competitive set.
So we've run out of time. Our time was short. Please join me in thanking Dan Lesser.
Thank you.
And